Hey everyone, welcome back to Corporate Decoder, the place where we break down the boring stuff so you don't have to. And let me tell you, this latest report has some moves that might make you say, wait a minute. Get ready because we're diving into a filing that is all about financing, or as I like to call it, the great money dance of Sealy Industrial Partners IV. LP, they've just had a bit of a financial rejig and we're going to unpack what it means for them, and maybe even for you. Make sure you are subscribed because we're making sense of these complex documents for you. And hey, join our Discord community linked in the description below to keep the conversation going. Alright, let's get straight into it. The main event here is a new credit agreement, and it's not just any credit agreement, it is an amended and restated one, which basically means they've taken an old deal, tweaked it, and made it official. This happened on the 15th of January 2026, and it involves a bunch of lenders led by KeyBank National Association. Think of it as refinancing a house, but for a big industrial company. So, what is the deal? They've got themselves a whopping $150 million revolving line of credit, which they can use as they need it. This is like having a credit card with a really high limit that you can draw from as business demands it and pay back as you're able. They also have a couple of term loans called Term Loan A and Term Loan B, which are set to $0 initially. Now, this might sound a little strange, but it hints at future plans. They can actually pump more money into these term loans later on, up to a massive $500 million combined with the revolving credit. This is what they call an accordion provision, meaning they can expand the borrowing capacity. Now, about deadlines. The revolving credit line, this flexible one, is good until the 30th of March 2029, but they can actually get an extra year if they meet certain conditions. The term loans, those $0 ones, have a more flexible maturity date, but it can't be earlier than the revolving credit line's date. This gives them a lot of room to maneuver with their financing. Of course, getting all this money doesn't come for free. The company paid some fees when they signed this new agreement, and there are also fees for unused portions of the credit line, which can be either 0.20% or 0.25% per year, depending on how much of that $150 million they're actually using. They also paid their general partner a pretty hefty 0.50% fee for help with the loan negotiations. That's a nice little bonus for the folks guiding the money. Now, how do they make sure they pay this back? This new credit deal is secured by a first priority lien on the borrower's real estate assets and equity interests. In simpler terms, if things go south, the lenders have a strong claim on the company's property and ownership stakes. This is pretty standard for this kind of financing, giving lenders a solid safety net. The agreement also includes all the usual legal stuff, promises, conditions for borrowing, and rules about what the company can and cannot do financially. This includes things like maintaining minimum net worth, keeping debt levels in check, and limiting certain investments and payouts. It is all about making sure the company stays on stable ground and can meet its financial obligations. But that is not all. On the 22nd of January 2026, just a week after signing the new credit agreement, Sealy Industrial Partners IV, LP released their Q4 2025 quarterly operations summary. This gives us a peek into how they were doing at the end of last year. Now, this summary is incorporated by reference, which means we can't see the juicy details in this filing itself, but it's important because it gives us context to the financing moves. Usually, a company rearranges its finances like this when it is planning a big expansion, acquiring new assets, or maybe just wants to get better terms on its loans. Looking at the financials, the key thing is this massive credit facility. The potential to borrow up to $500 million is a really significant statement of intent. It tells us that Sealy Industrial Partners IVLP is likely gearing up for substantial growth or strategic moves. The fact that they've secured this with their assets shows they are confident in their ability to manage this debt. While we don't have the full Q4 2025 results in front of us, the timing of this report's release points to a deliberate strategy. They lock in their financing and then they release their operational summary. It is like filling up the gas tank before a long road trip. Now, let's break down what this all means. Sealy Industrial Partners IV LP, through its subsidiary, is actively managing its financial architecture. This amended and restated credit agreement signifies a proactive approach to capital management. The initial $150 million revolving credit line provides liquidity, and the expandable accordion feature up to $500 million suggests a strong outlook for future growth or opportunities. The interest rates on their loans are tied to their leverage ratio and the type of loan, which is pretty standard. For example, if their leverage ratio is low, their interest rate on certain loans, like revolving credit base rate loans, will be base rate plus 0.75%. If it is higher, it nudges up to base rate plus 0.85%. For SOFR loans, it is 1.75% or 1.85% respectively, plus the adjusted SOFR rate. This means they are incentivized to keep their debt levels under control to get the best rates. The fees, while seemingly small, add up. The 0.50% financing coordination fee paid to their general partner is a significant chunk of change on a large facility. This highlights the importance of expert financial guidance, but also raises a question about potential conflicts of interest or just a healthy compensation for services rendered. The fact that the credit facility is secured by real estate and equity interests is a strong indicator of the underlying value of the company's assets. This is a vote of confidence from the lenders, but also a significant pledge from Sealy. Now, for the Q4 2025 operations summary, again, we don't have the raw numbers here, but its release shortly after the financing deal is like a signal flare. It suggests that the operational performance either supported the need for this financing, or perhaps the summary contained good news that made lenders more comfortable. Without the actual report, it is hard to say for sure, but it is a piece of the puzzle that is intentionally placed. Looking at the broader picture, Sealy Industrial Partners IV, LP seems to be in a growth phase. Securing substantial debt capacity means they are either preparing for significant capital expenditures, acquisitions, or possibly refinancing existing debt at more favorable terms. The risk here, as always with debt, is execution. Can they deploy this capital effectively to generate returns that outweigh the borrowing costs? The covenants within the agreement, like leverage and fixed charge coverage ratios, are designed to mitigate these risks by imposing financial discipline. A notable opportunity is clearly the expansion potential of the credit facility up to $500 million. If Sealy can find attractive investments and manage its debt prudently, this could fuel significant expansion. The risks, however, include broader economic downturns that could impact their industrial operations and their ability to service their debt, as well as interest rate hikes that could increase their borrowing costs, especially on unhedged portions of their debt. In conclusion, Sealy Industrial Partners IV, LP is making some big moves on the financial front, setting itself up for what appears to be a period of significant activity. The $150 million credit facility with room to grow substantially is a testament to their confidence and their lenders' belief in their underlying assets. The key will be how effectively they can leverage this new financial firepower. Alright, that is our breakdown of Sealy Industrial Partners IV LP's latest filing. What is your take on these financing strategies and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.